the U.S. stock indices, the S&P and the NASDAQ, hit all-time highs. And I'm speaking the second week of November of 2019. How did it happen? There's been incredible surveillance of the U.S. economy, one account after another of how our economy is getting somewhat weak. So why is the stock market indices reaching all-time highs? Well, it turns out there are stealth ways it's happening via economic and financial policy, not necessarily in the United States. In this particular case, we have had a major development in the European economy and the European Central Bank. It turns out that the European Central Bank is at the heart and core of our stock market influences today. Here's how it works. It's a chain, a reasonably long chain, but conceptually you have to get your mind wrapped around it. The European Central Bank, in its role of generating easy money to stimulate the economy of Europe, to keep the economy moving ahead with jobs and wage growth and profit growth, etc. Their typical way of doing it is literally printing money and buying the sovereign bonds of the countries in the Eurozone. The purpose of this is to create demand for Euro bonds, increase the price, which has the effect of reducing the yield in the market. The linkage is basically the market will pay a higher price for the same dollars of income from bond contracts. So the buyer drives the price, and in driving the price up reduces the percentage return to them, since the contractual return in euros is fixed. That's the nature of a bond. So how interest rates decline as a result of central bank intervention, and here's the stream. Basically, they print money, literally print money. They go into the euro secondary market. They don't buy bonds from the European sovereigns that are bond issuers. They buy already existing issued bonds from private holders of those bonds, which typically are institutions like pension funds, endowments, insurance companies, etc. So basically, these bonds get purchased, and when there's more demand and in the short run no more supply, that means the prices rise and it means the yields decline. So now, having literally printed the currency and bought the bonds from the private holders in Europe of those European bonds, they now have set off a chain reaction, and the chain reaction gets all the way into the United States, into our financial markets and into our stock market, and affects our prices in our markets. And here's the chain of events. They buy the bond from an institution who now has the cash printed by the central bank. They are now missing an asset, so to speak, an income producing asset from their portfolio. And as institutions, they literally are given like 24 hours to find a replacement asset for the asset they just sold to the European Central Bank. So the question becomes now, what do these folks do or settle on as a substitute asset? There's not much sense going back into the bond market and buying the same asset at a higher price, at a lower yield. But basically, they have sold their high quality bond holdings to the European Central Bank, now have cash. They now have the requirement that they need a substitute asset. Now, what kind of substitute asset? Well, each one of these institutions, whether it be an endowment fund, be a pension fund, whether it be an insurance company, they all have obligations to meet in their currency of future payments. So they're going to be looking for a substitute asset that generates interest income or profit income of any sort, to generate enough euro to pay their obligations in the future. So the search goes on. Once they've sold that treasury, a euro treasury, to the European Central Bank, they now have a problem. They have to find an alternative asset, that income producing. And basically they have typically 24 hours to find the replacement. So the search goes on for something that has a higher yield to generate enough income to meet their obligation. So you look across the European markets, and basically that huge demand for bonds by the central bank has already affected, for example, corporate bonds in the Eurozone. And they start to look around further, and what they've seen, at least up to about a year ago, that the U.S. interest rates on the U.S. bonds were considerably higher. Our rates were like 3.5% for the long-term treasuries. Their treasury rates have been pushed all the way down, not only down to zero, but to negative territory. So how can you run a pension fund with negative yield on your assets and meet the obligation? Well, the question is, can you turn around and sell those to the central bank at a high price, take the proceeds, and invest in 3.5% U.S. treasuries, which are high-quality debt. The only risk to them, or the main risk to them, or the biggest risk to them, is the currency exchange, because they will have to switch from euros to dollar holdings to meet euro obligations. So they do end up, if they buy U.S. assets, with some exchange rate risk, which they can hedge. But the differential is huge, because the interest rates in the U.S. markets, long-term treasury markets, had been in the threes, and in Europe they had been negative a half. So that's a 3.5 point spread. True, there's a cost of switching to the dollar and hedging your future access to euros, but that spread is enormous. So basically, the private pension funds widen their search to other currencies when everything in the euro market has already been bid up in price. So they leap the fence, so to speak, into dollars, and from dollars into U.S. assets. Now, why is this new news? Well, it is new news. It's essentially happening in the last year, since 1990. What prevented this prior were something called capital outflow restrictions. Countries in general did not allow private investors to switch their capital to foreign holdings, for a good reason. You know, the logical reason, going back historically, and this goes back a long time, hundreds of years, basically countries are adverse to having their economic participants accumulate savings in their currency and take their savings and buy a foreign security to invest in a foreign enterprise. As an example, let's say Ford Motor Company would be selling bonds to build a factory in Detroit. Well, basically the countries, and particularly smaller countries, do not want their savings to be converted to dollars to purchase bonds by Ford Motor Company to build a factory in Detroit. They're willing to have their savings committed that way, but only if they can induce Ford to come and build the factory in their country and hire their folks. But basically, capital outflow restrictions have been part of the background of that, the segmented capital markets across the world. Countries don't want their savings financing investment and economic activity elsewhere, in other countries. So basically, that has been part of our intergovernment, inter-country framework for some time.